Today we look at a session on complex groups in consolidation of financial statements. A parent company at this level will be required to consolidate two subsidiaries. There will be different types of acquisitions. Let's start with an acquisition where a parent acquires a subsidiary, and that subsidiary also acquires another subsidiary. The parent will have to consolidate for both subsidiaries as long as it controls the subsidiary, the immediate subsidiary it has acquired. In this illustration, P acquired 60% of S1, the S1 acquired 60% of S2. Since S1 controls S1 controls S2, and S1 is controlled by P. P effectively controls S2. So the effective interest in S2 has to be determined. The effective interest in S2 will be 60% of 60, which gives us 36. So P effectively controls S2 by 36, and therefore the non-controlling interest in S2 is 64%. In the statement of financial position, P will consolidate S1 and S2. All assets and liabilities will be consolidated on a line-by-line basis. In the equity section, only the parent's share capital will be shown. The consolidated reserves, which will be done as a working, and the NCI, which will be done as a working, will be based on the effective holding. In the statement of profit and loss, will show what the group controls. The non-controlling interest again will be based on the effective holding. Like before, the major workings that you'll be required just at the beginning of your consolidation will be the calculation of goodwill and the post-acquisition profits, which usually are computed in the consolidated retained earnings. When calculating the goodwill and the post-acquisition profits, the date of the acquisition of the subsidiary by the ultimate parent will need to be considered carefully. So let's look at the following illustration. In this illustration, the first illustration, the parent P acquired S1 on 1st January X5. Then later on 1st January X7, S1 acquired S2. Effectively 1st January X7, P controls S2, and the effective interest in S2 of P is 70% times 90%, which gives us 63%. The NCI will then be the remainder at 7%. If you look at the second illustration, P acquired S1 on 1st January X5, whilst S1 acquired S2 on 1st January X2. So immediately P acquired S1, it effectively controlled S2 as well. The goodwill calculation has to be done for each subsidiary individually. The goodwill calculation for S1 is an area that we have seen before, but it's the goodwill calculation in S2 where we're going to put a lot of emphasis. Whatever S1 spends, %70 of it belongs to S1. Therefore, the consideration which S1 pays, we only get 70% of that in the goodwill calculation. The 30% belongs to the NCI and will be dealt with in the NCI calculation. Once the two goodwills have been calculated, they are summed up to get one total, which will go into the balance sheet under the non-current assets. Let's illustrate this in this question on Abacus. Like in any consolidation, the timeline is of great importance. The timeline, which being our reporting date, in this case, the 1st December 20x8. So the timeline will be from 1st January 20x8 to 31st December. We can see from the balance sheet that Abacus invested 69.3 million in Britain and 24.8 million in Chim. So we need to calculate the goodwill. Before we do that, let's determine the percentage holding from note 1. So Abacus acquired its 70% holding in Britain on 1st January. So you notice that 1st January is outside our timeline, and Britain's reserves stood at 72.6. Britain had acquired its 80% holding in C on 1st January 20x6, when C's reserves stood at 19.9 million. At 1st January 20x7, the reserves of C stood at 23 million. A cannot consolidate C as at 1st January 20x6 because as at 1st January 20x6, Abacus did not control Britain. So Abacus can only consolidate C as from 1st January 20x7 when it acquired the 70% holding in Britain. So it's on this date that it effectively controls C. So we need to determine the effective control, which will be 70% times 80%. Therefore, the effective interest in C will be 70% times 80, which is 56%. The NCI will therefore be 44%. So those are the workings for the goodwill. The consideration, we'll start with Britain. A paid 69.3 million. The NCI, we are told, the NCI, we have it there in note 4, was 28.2 million. Then we take out the fair value of the identifiable net assets acquired, which is the share capital of 10. We have the share capital of Britain, there are 10. The reserves, we need pre-acquisition reserves at the date of acquisition, which were given in note 1 as 72.6%. Then we have a fair value adjustment, customer relations of 3.5. That gives us the total of 86.1, which we subtract from the consideration and the NCI to give us goodwill of 11.4 million. We move to C. B acquired 80% of C, paying 19.4 million. Now its reserves, now 19.4 million, so 70% of this the 19.4 million was paid as at 1st January. Now, investments do not remain static. companies invest so that they could create wealth. So this investment on 1st January, we need to determine how much it was as at 1st January 20x7 when A gained control of B. So we get to the balance sheet. We are given there that this investment is now worth 24.8 million. So it's this 24.8 million that we use to compute the goodwill. So 70% of 24.8 will belong to the parent. The NCI were given its value in note 4. We're told the market value of C's $1 shares was 7.50 each on 1st January 20x7. That's the date on which Abacus gained effective control of C. So that's the one that we need to use, not the one as at 1st January 20x6. So the effective holding, which we established earlier on at 44%, that's the one we use. So 44% times the number of shares in C. We've got here 4,000 as the value of the shares. So 4,000 divided by $1 ordinary shares will give us 4,000 shares. So it's this 4,000 that we apply the 44% and then the 7.5% in note 4 to give us the NCI value of 13.2. We bring in the share capital of C in the reserves as at 1st January 20x7 of 23,000 to give us a total of 27 and goodwill of 3560. We then add the two goodwills to give us the total goodwill of 14,608. Once we are done with the goodwill, we now move to the consolidated reserves. The consolidated reserves we draw out 3 columns for each company in the group. We start with the reserves as given in the question for Abacus, Briton, and Chimney. So these reserves are what you are given in the balance sheet. They are under reserves. Then we've got the fair value movement, the fair value adjustment in note 1. We're told the customer relations had a useful life of 5 years. Now, $3.5 divided by 5 will give us 700 as amortization per year, which will go to cost of sales. However, we are in the 2nd year since acquiring Briton. So the amortization will equally be for 2 years. So 700 times 2 give us 1,400 as amortization. Then we have in note 3, Britain sold goods worth 18,000 to Abacus at a markup of 25% on credit. 4 million of these goods were still in stock, so we need to compute the unrealized profit. I hope you still remember how to use markup. Markup simply means that your cost will be at 100%, your selling price will be 100% plus whatever markup. So to determine the unrealized profit to be 25% divided by 125 times 4 million, the goods which are still in stock. To give us unrealized profit of 800,000. Since Britain is the one who sold, this unrealized profit will have to be subtracted from Britain. Then we bring our pre-acquisition reserves, the ones which we have already used in the goodwill. The 22.6 and the 23 million, the ones which are there in the goodwill. Once we are done with the notes, we close the subsidiaries first, then we transfer our share of the subsidiaries post-acquisition reserves to the parent side. Britain, we transfer the 70% of 13.7. In C, we have an effective control of 56. We transfer 56% of the 7,000. We then close the parent to give us the consolidated reserves that we're going to take to the balance sheet.